What is investment? Investment is an asset acquired or invested in to build wealth and save money from hard-earned income or appreciation. Investment meaning is primarily to obtain an additional source of income or gain profit from the investment over a specific period of time. Investment involves putting capital to use today in order to increase its value over time. An investment requires putting capital to work in the form of time, money, effort, and etc., in hopes of a greater payoff in the future than what was originally put in. Investing is buying stocks and other assets and holding them for the long term. A long-term investment horizon often uses a passive investment strategy, meaning there is a little active buying and selling or trading happening. However, some investors may choose to enter and exit positions every few years or when their investing strategies tell them to do. Stock markets typically rise over the long term. The stock market has historically risen over the long term at a greater rate than inflation. Therefore, investing in stocks not only offers the chance to protect capital from inflation, but to increase wealth over time as well.
Time commitment. Investors who own stock indices or index ETFs have little work to do. By being invested in an index, the market does the work for them. Investors just hold the positions for the long term to achieve market average return. A savings plan that grows. Investing is like saving, but funds can grow at a much higher rate than most savings accounts offer. Most investors opt to save for retirement and or for the future expenses, while some emergency cash can be kept in a saving account. Many investors opt to put a large proportion of their savings into an investment that earn a greater rate of return.
Investing is not limited to stocks. Investing provides options. While stocks are a common investment, so are bonds, ETFs, real estate investment trusts or REITs, and precious metals. Bonds issued by stable companies or governments tends to have less volatility than stock but also have lower long-term returns. That said, they often offer returns that are higher than a savings account. Therefore, even if stocks have little appeal to you, there are often options for investment. Less tax. Long-term investments are typically treated more favorably in terms of taxes than short-term trades. There are also certain investment accounts that may further protect investment gains from taxes, such as stocks and shares ISA.
Investment can be provide income, whether it's now or later. Investing can be provide regular income from divided stock or interest bond. When a bond or dividing playing stock is the purchase, is a play a center percentage to your regular intervals. This income stream can be invested to take advantage of compelling return or use for something else. Investing is flexible. Investing is not a one-size-fits-all process. Investor how choose to invest a stock and which stock they want to own. An investor choose an asset allocation that's based on their risk tolerance. For example, holding more stock for higher return to holding more bonds to reduce volatility and the portfolio.
Disadvantage of investment, possibility of loss. When investing, there is possibility of loss, while major stock indices such as S&P 500 and FTSE 100 have risen over a long period of time. There are no guarantees that the market will rise during a specific investor's time horizon. Compounding is low. Investing doesn't compound capital as quickly as successful short-term trading does. Therefore, all else being equal, a good investor will make lower returns than a good day trader or swing trader.
Investing isn't active if you want that. Investing is generally passive, with trades lasting long periods of time and little active buying and selling. This may not appeal to investors who like doing lots of research and being active in the market. That said, there is always the option to be active in the market but also have some funds invested as well. Opportunity cost. When we invest, we are giving up the use of that capital in exchange for potential earnings over the long run. An investor could be using that capital for something else. For example, we might use it to redo our house, take a vacation, go back to school, or start a business. Some of these are alternative forms of investment, but ultimately, if we allocate capital to investing, it can't be used for something else, at least not while it is invested.
High expense ratios and sales charges. If you're not paying attention to mutual fund expense ratios and sales charges, they can get out of hand. There are several good fund companies out there that have no sales charges. Fees reduce overall investment returns. High expense ratios and sales charges, sila yung mga mataas na mga ratio ng mga gastos at mga singil sa pagbebenta. Second, management abuses. Corny turnover and window dressing may happen if your manager is abusing his or her authority. This includes unnecessary trading, excessive replacement, and selling the losers before quarter end to fix the books. Second, management abuses. Sila yung mga pang-abuso sa pamamahala. They tolerate employees.
Tax inefficiency. Like it or not, investors do not have any choices when it comes to capital gain payouts in mutual funds. Due to the turnover, redemptions, gains, and losses in security holdings throughout the year, investors typically receive distributions from the fund that are an uncontrollable tax event. Poor trade execution. If you place your mutual fund trade anytime before the cut-off time for some day, NAV, you'll get the same closing price. NAV is for buy or sell on the mutual fund. For investors searching for faster execution times, maybe because of short investment horizons, day trading or timing the market, mutual funds provide a weak execution strategy.